Market news now. Stocks are down as an ongoing rout in global bond markets saw U.S. bond yields reach 16-year highs, challenging equity valuations and souring appetite for risk assets as investors bet that interest rates will remain persistently high. Meanwhile, stronger than expected U.S. job openings data had sent the 10-year yield up nearly a dozen basis points, its highest since 2007. 30-year Treasury yields rose above 5% for the first time since August 2007. And in commodity markets, the stronger dollar has helped put the brakes on oil prices, and higher yields have weighed on gold. To give us more perspective about what is actually happening when it comes to that global bond market rout, we are joined by Patrice Rousseau, who is the Chief Investment Officer at Ashburton Investments. Patrice, thank you so much for your time. On the back of this accelerating sell-off that we are seeing in U.S. government bond, what do you make of the impact it's having on other parts of the market?
Yeah, good afternoon, Anastasia, to you and to your viewers. Definitely a lot of noise coming from the U.S. markets. They narrowly averted a shutdown, which would have meant that the U.S. government wouldn't be able to pay salaries, but we continue to see pressure on the yield curve with the longer-term interest rates rising to, as you say, already highs that we've last seen in 2007. So not too long ago, we had U.S. yields which were well under 1%, and they're now nearing 5%. Which in an economy where inflation is targeted at 2% is a very high real interest rate. And that's putting pressure on other emerging market yields, including our own interest rates, which doesn't bode well in terms of economies which are already slowing, are already struggling, and trying to face off to higher inflation, higher oil prices, now higher long-term interest rates. So that's quite concerning. We've seen bond markets come under huge pressure. Equity markets have wobbled a little bit, but not as much as one would expect, given the higher bond yields around the world.
With everything that's currently taking place right now in the markets and everything we experienced in the third quarter, what would you say is the current debate in the market right now?
Yeah, there are many interesting debates. I think the one is whether inflation will go back to its long-term levels. So we've seen in South Africa inflation go back to the target range from the Reserve Bank, which is between 3 and 6%. So we're there. But the big issue is the US. Like, they have a long-term target of 2%, and they're still well above that. And the question is the Federal Reserve and other central banks like the ECB going to continue hiking interest rates, which would then force, for instance, our own governor, our own Reserve Bank to follow suit and increase interest rates further, which is going to put pressure on the consumer and halt any economic growth that we might have seen nascent at this beginning of the year. So the question is that, does the world continue as is, or do we plunge into a recession into next year?
The higher for longer narrative, how does it affect corporate America, especially when it comes to the numbers we can expect from a lot of these companies reporting their figures, and I suppose also the impact on the balance sheet?
Yes, it's a very interesting question. The corporate America has benefited from very low interest rates, and a lot of them have locked in their interest rates basically 3 years ago during the COVID lockdown. So we're not going to see that impact straight away. Same thing, there's a lot of mortgages in the US home loans which experience fixed interest rates. So we're not going to see that happening going forward. But I think the big difference is, as we see interest rates reprice, we're going to see pressure. Already there's been a moratorium on student loans, on student debt, which has been removed, which means that they have to start paying back their student debt, and that's going to put pressure on the consumer. Same thing with credit card debt. So around the world is your more unsecured lending where we're going to see pressure in terms of the higher rates, and that will put pressure on demand going forward.
On that note, then, what could have a material impact on market sentiment or even the direction of the markets?
I think we've seen already in the first quarter a bit of a mini banking crisis in the US. I think there's a lot of concern about property markets. We've seen a property crisis with two of the major property developers in China effectively going bankrupt. There's concern that could we see another mini banking crisis emerge? Could we see greater pressure on property markets in the developed world? I think these are big risk areas which the market is looking at. And unfortunately, higher interest rates are likely to accelerate these risks or heighten these risks.
In a higher for longer environment, are there sectors of the market that do well?
Yeah, I think the more defensive sectors of the market, your real consumer staples will do well. And obviously, savers, people who have money in short-term money market type instruments will benefit from that. You must again remember that the developed world has had close to zero interest rates, and now suddenly they're experiencing 5% interest rates. So it was a world which favored before borrowers. Now it's going to favor savers or people who are more cautious. And in terms of equity markets, the more defensive sectors, the staples, the lower valued sectors are going to do much better than the more highly valued sectors.
Before I let you go, just quickly, how important is the latest data point coming out of the US on Friday?
I think, again, everyone's looking for signs to see whether the US economy is going to start to slow down, because, as we discussed already, the concern is that the Federal Reserve might hike further. So any signs, and in this case, bad news is going to be good news. Any signs that the US is starting to slow down will be seen as good news in the market.
All right, Patrice, thank you so much for your time. That is Patrice Rousseau, who's the Chief Investment Officer at Ashburton Investments. And news coming in that Anglo American has begun cutting its office workers globally, starting with South Africa. 181 notices being issued at its corporate offices, and this in particular affecting its Kumba iron ore unit. However, that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.